IVM.
On this episode of Paisa Vaisa, my special guest Deepak Shenoy, founder and CEO of Capitalmind, talks to me about active investing versus passive investing. Hot debate globally. Deepak is going to talk about the same topic with an Indian perspective. Stay tuned for that.
You know what it's been? Like every week has been an awesome week on IVM. This week on IVM, we got the 300th episode of Cyrus Says. To mark this milestone, Cyrus has an MTV VJ reunion with Malaika and Nikhil Chinnappa. Listen in for tons of laughter and nostalgia. You really don't want to miss this. 300 episodes. On the scene and the unseen, Amit Verma is joined by a farmer leader, Gunwant Patil, to discuss India's agricultural crisis and the state of farmers. On Know Your Kanun, lawyer and host Amber Rana helps us to understand the complexities related to the laws and rights regarding cruelty. Last week on the Pragati podcast, Pawan and guest host Shambhavi Nayak were joined by renowned scientist Dr. Kumarasamy Thangaraj to discuss the great genetic diversity of India. On the Kinetic Living podcast this week, Coach Urmi talks to stand-up comic and the host of Keeping It Queer, Naveen Narona, about his busy schedule and the struggle to create a fitness regime for himself. And as always, if you're not following us on social media, please make sure that you do. We are IVM Podcasts on Twitter, Facebook, and Instagram. We do a lot of really interesting stuff over there. Also, make sure you check out our YouTube channel. We have this thing called IVM CCTV over there where we give you guys a glimpse into the studio. And with that, let's continue with your show.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter. We are continuing our Bangalore special all the way from the Resonance Studios at Bangalore. I have with me Deepak Shenoy, founder of Capitalmind. We just finished a long format where we spoke about a lot of things. We spoke about Deepak as an entrepreneur, as an investor, his take on the markets. This is our typical episode where we're going to talk about specific topics. Okay, so Capitalmind is all about active investing. So Deepak, welcome back to the show. Let's get into this. This whole active investing versus passive investing, सारा दुनिया में ये छा गया है. ETF में पैसा जा रहा है. Here's Capitalmind, whose tagline says active investing. Okay, let's talk about this. Active first, of course. Please tell our viewers. Okay, some of which I in fact didn't know what is passive for quite some time. What is passive investing? What is active investing? What is this debate about? Please.
So Anupam, the interesting thing about debates is you always have data that supports both sides. Active investing is essentially where you're actively making decisions to invest in markets on a regular basis. And this may not happen like on an every day, every hour, every minute basis, but at some point you're responsible for making the investment decisions that will make you money. Whether this is by buying stocks and bonds yourself. That's one layer of active investing. Another layer of active investing is choosing which mutual funds you're going to buy, and you can be as active as you like in that frame as well. In a mutual fund scenario, if you are just to do an SIP in one fund and kind of stay with it for a long time, you are now a passive investor because you're not making any investing decisions. You're just saying, I'm giving you money, do whatever you want. They're doing whatever they want, and you're kind of going to look at the results over time. An ETF is also an example which chases an index, because even there the investment manager himself does not make any decisions. He just buys stocks in an index. The index is decided according to some fixed criteria, and a lot of times because everybody buys money into the same ETFs put money into the same stocks, who then rise in price. And they obviously become the highest market cap companies, and then more people invest money in the same thing. And so it's kind of like a positive feedback loop. We just don't know how this is going to play on the other side. But what I feel is, in the last 10 years, we did a lot of analysis. When markets are valued cheaply, it actually makes sense to do a broad market approach. Buy your ETFs, buy whatever you like. And, when the market's in the doldrums, you will actually find that large caps do almost as well as mid caps, which do almost as well as small caps. When markets are at highs or in the upper end of the equation, your choices of mid caps or small caps will actually, in the long term, have a much more better return than your larger caps, which typically tend to be much more highly valued in a bull market. Now, I say this as general because as much as I've tested, we don't have too many 10-year periods in India to test. But for what it's worth, this kind of equation even works in the US, where the mid-cap universe is slightly bigger. I've just narrowed down to about 150 to 200 stocks called mid-caps, 150 to 200 stocks called small caps. Yeah. So our tests actually reveal that. So an active investor would actually go in and say, listen, I will actually go and choose those stocks. I will find those stocks. I will buy them. I might use an active investing strategy. That strategy may say, I will buy a portfolio of 10 such stocks. I won't buy a pharma stock, I will buy 10 pharma stocks. Active investing is all about just taking things on your own and making those financial decisions for yourself. Because a passive manager has only one deal. Take your money and deploy it into whatever asset class he's supposed to buy. You as an individual can choose between asset classes at different points in time. You want to make space for all of that. The most important part of active investing is just deciding where to put your money and where you want to go. So I think the concept of active is just being more active with your money. Treating it like a friend who you have to guide, because he will come and help you at a later point in time. So you need to know where you want to go, how much wealth or what kind of wealth you want to create, and therefore track your progress and see if you're doing the right thing over time. This is still your job. No fund manager is going to do this for you. Some advisors may say they will do it for you, but in the end, it's your responsibility. We just say that be more involved actively in this process. In the end, if you choose that I will use a passive instrument like an ETF, you're still an active investor who made that choice.
Okay. Folks, I'm just going to translate a little bit of that for you. An ETF is an exchange traded fund which tracks an index. Okay. That's like saying that instead of buying Reliance, TCS and HDFC Bank, you're actually buying the entire Nifty. Okay. So an index is like the Nifty is an index. The BankX is an index. So there are a lot of indices which are built by companies which trade on the markets, and exchange traded fund essentially just buys the same set of stocks. So when Deepak was saying ETF, he meant exchange traded fund. What's the difference between an ETF and an index fund?
So the index mutual fund in India, there is a difference. In the US, there's a much more technical difference. In India, the only difference is in an ETF, you can buy it in market hours, different prices. The price is real time. They can go up and down according to the market. Like today, the market is falling. If I were to own a mutual fund, I could sell it only at the end of the day's net asset value. That means whatever, if the market tanks another 10% from here, then I'm going to get the 10% lower number. The ETF allows me to sell in the market at the current price. So if it falls another 10% from here, I won't see that remaining 10% fall. I would have sold at today's price right now. So the ETF is just traded on the exchange.
Okay.
The index fund is just the same thing, which buys the same kind of stocks. There are small other technical differences, but that's not relevant.
Tell me one thing. From whatever I read, whatever I hear in the papers, I think there's enough data to support it also that over the last, I think 3-5 years, large cap funds just haven't managed to give any alpha. Okay. So that's one aspect. Okay. Let's keep that there. And then you've got a beautiful index called the Nifty Next 50, which I think would have probably beaten a lot of mutual funds, actively managed funds over the last, I think 5-10 years. I think Vashishta has the details on that. He had posted on Twitter also. What is the deal out here? I mean, why is this happening? I mean, if this is the case, I'll just put 50% of my funds into a Nifty ETF, 50% of my funds in Nifty Next ETF. I'm paying close to nothing. I'm 0.5, 1%, and I'm happy in life. What's happening out here? Is there something that we're missing?
No, actually, you're right, because even I thought, for the most part, mutual funds were beating indexes. I did a recent back test, and I found that the large cap funds, the funds that are now mandated by SEBI to invest at least 80% of their corpus in only the top 100 stocks, so their universe is limited, these funds have struggled to beat the combination that you just talked about, 50% Nifty, 50% Next 50, on a 5-year return basis. So if I took a 5-year return today versus that means I invested 5 years ago and got out today in the two options. One is 50% Nifty and 50% Next 50 or in a large cap mutual fund. Most 99%, I think almost all large cap funds have underperformed the combination on a 5-year perspective today. But today is one day. Let me say 6 months ago, if I took the same 5-year return, would they have beaten? The answer is yes. 1 year ago, they would have beaten. And I'm talking of a 5-year return. 2 years ago, they would have beaten. And even 3 years ago, they would have beaten. So for 3 years, you're having a long-term underperformance of large cap funds versus an index fund combination.
Right.
And I'm not talking 0.5% or 1%. I'm talking about as much as 4% underperformance per year.
Okay.
This is an absolute terms. But in general, this is not something to scoff at.
Okay.
And I feel that in the longer term, the large cap funds will struggle. But the same test. Now, see, you don't have mid cap funds to invest in.
Yeah.
So you can only do Nifty and Nifty Next 50.
That's right. Yeah.
So assuming that you took Nifty and Next 50 as one combination and then a mid cap fund as another combination, the mid cap funds have beaten the index. Now you might say to me, Deepak, why don't you look at the mid cap index?
Yeah.
I said, फिर invest कहाँ करोगे? कहाँ ETF?
There is no
the
mid-cap ETF.
If there isn't, then let's stop talking about it until there is.
Okay, folks, just to be technically correct, there are a few there are a few mid-cap ETFs, but we're talking size, liquidity, AUMs. If you look at the Nifty ETF managed by SBI, it's the largest in India. It's the largest mutual fund in India. Is the SBI Nifty ETF. It's got tons. It's got that's a large number. Whereas my guess is the largest mid-cap ETF, I think the Moti M100 or something of that sort is what? It's not even 100?
Not even 100.
Not even. So that's what Deepak is saying, that where are the mid-cap ETFs? Where are the small-cap ETFs? Please.
You can't really go in size in the mid-cap ETF. So therefore, I feel it's not useful to compare them. When they become of big size, we will talk. But in many cases that I have tested, the mid-cap ETFs have been beaten by the mid-cap mutual funds. Part of that is because the ETFs currently have a lopsided cost structure. Now, when your AUM is only 70 crores, you can't afford to charge only 0.1%. You have to charge 1.5% because you've got to pay the salary of somebody and all the people that go around creating the mutual fund and so on. So your problem really is size. When they become much bigger, they might actually be more attractive, but right now they're not. So there is a dichotomy. The mid caps are beating, the large caps are not. Maybe tomorrow the mid caps will also not. But we haven't come to that point yet. It's useless to predict that they will. In the large caps, I can see why. There are reasons. Because hundreds of people cover large caps. Everybody wants to buy large caps. 85% of all mutual fund investments in India are in large cap funds. Or multi-cap funds, which are mostly large cap.
Sure.
So 85% of the money that's sitting in India, Indian mutual funds, will go to large caps only. That's the top 100 stocks. FIIs, they don't want to buy mid cap and small cap stocks, so they will buy large caps. There are places like Vanguard, MSCI Index, they're again large caps. The ETFs abroad are large cap that invest in India. And then you've got the direct investors in the large cap companies like PMSs or from AIFs. They also invest in the large cap. So when so much money is chasing a very small set of stocks, you don't have an edge. Whereas the mid caps and small caps, the manager may still have an edge. And I believe that edge will continue until the market matures to a point where the mid caps also get overwhelmed. We are very far away from that point. We take about 5-6 years. So I feel mid caps and small caps continue to be active as an investor. And that's where the most money is, in my opinion. If I look at stocks that made 10 times in 10 years, in the last 10 years, out of about 43 stocks that are today of any reasonable size, only 5 came from large caps. That means they were large caps. One of them is Maruti, by the way. They were large caps when they started. They are still large caps today. The remaining stocks were either mid, small or micro caps. And I'm saying all of them have grown to become large caps or mid caps today. I mean, they're big enough today to be considered. So when you have only 3% or maybe only about 10% of your stocks coming from a large caps, when you invested 10 years ago, and we've done this test of whether it's 2018 you end up with, or 2017, 16, 15. Large caps are not a great choice to have in your portfolio when the markets are at a high. When the markets are low, they are a great choice to have, because I think they come into much more reasonable valuation. So today we are at that stage again. I think it would be a mistake to say that active investing should be shunned because the data actually tells us that it's time to get active, especially because you will find bargains only in stocks which are unlikely to be the part of the crowd.
Okay. So the related question to this is how much of performance is worth paying for, right? Because this entire debate of active versus passive has an entire grounding in the payment that I as an investor make for this performance. And therefore, if I'm not getting any alpha, तो भाई मैं तुमको क्यों मैं fees दे रहा हूँ? Okay, and this entire thing about regular, direct and all that. So what's your take on that? How much, is performance really worth paying? Has the mutual fund industry gotten too much in the last few years? And where is this going forward?
So I think mutual fund fees themselves have been evolving. They've come down a little bit from the times of 2007. They've been increasing in the last 2 or 3 months maybe. But I think there are two kinds of people. One is a person who does not have the discipline, who would be happy to pay 1% just to get disciplined in terms of investing. And these people do it. They pay 2% or 1% by direct or regular funds on a regular basis. They're just happy that money is getting invested. Now 1% is a small price to pay for discipline. It's like saying if a person comes and helps you, save a medical bill of 1 lakh rupees, would you not pay him 1,000 rupees a month?
Hardly anything.
It's not a big deal, right? So if to save yourself from a heart attack, you'll pay a gym trainer 5,000 rupees a month because a heart attack costs you 5 lakhs. I mean, just looking financially apart from the health aspects of it. But if at the same time you do this for your financial health, you're in a similar phase where you're saying, I'm paying 1% for the discipline because I'm not disciplined enough to do it myself. The second is the guy who looks for performance. I suggest to all these people that invest in everything because you can see relative performance on a multi-year basis. And then just keep giving more money to the guy who's performing the best. Whether it's a mutual fund whose performance is evaluated after his fees or an index fund, again, who's got lower fees, therefore his performance should be better. Or it's your own direct investments. So whoever does better, it's like, if you own, multiple cars, you'll drive all of them, but you'll drive the one that drives the best, the most. So your attitude towards investing should be like, I have multiple, don't never call them children. You're not married to them. They don't love you back. And no investment will.
It's sell them.
You never will sell them. So they're not your children. They are not people you nurture and give equal weightage to everybody. It's very straightforward. It's a capitalistic world. Perform and you'll get more money. That should be your attitude as an investor. I won't say 1% is bad, 2% is good, but it applies to you as an investor whether you want to pay it or not.
Okay. Last question for this part, for someone who's just starting off, what would your advice be between active and passive? I mean, how this is a guy, who really doesn't have time in life, salaried guy, 9 to 8 or whatever, 10 to 10 kind of jobs. He just wants to start whatever, an SIP or whatever it is. What would you tell him about active versus passive?
So actually what I would do today is to say for large caps, take about 60% of your exposure through this Nifty 50 and Nifty Next 50.
So number one, have an asset allocation, let's say whatever, 60% large caps, 40%, no problem. Okay.
So 40% remaining, you can do a bunch of things. Whether you want to put some money, I mean, think of it as if, listen, I have 10,000 rupees. 6,000 rupees is going to go straight to my large cap exposure. And because I feel that the Nifty Next 50 combination is better, I'm going to do that right now. The next part of this equation is about the remaining 4,000.
Okay.
I say that 4,000 should go into more risky stuff. So you put your mid cap fund 1 month, another month you put it into a small cap fund.
Sure.
The third time you buy, let's say, a US NASDAQ fund, which is investing in the US. Spread that out into riskier investments, which you feel are not, so 60% is relatively in larger caps in India and 40% is in these companies. Do this for a year. And then sit back and look at what you've done and what's worked and what's not worked. Again, like I said, whatever's not worked or has been a complete failure because maybe they've underperformed their indexes and so on, get rid of those, clean it up, and then start giving more money to the ones that have. And over time, you will build yourself a very decent portfolio. It doesn't take a lot of rocket science. It's just like one day in a year that you have to do this and one day in a month that you have to invest.
And you learn a lot. Great. That's a wrap on the first part of our series with Deepak Shenoy of Capitalmind. The theme of the series is active equity investing. This episode was on active versus passive. The next episode is going to be on portfolio management schemes, or as we call PMS. So stay tuned for that.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Look! Up in the internet! It's a meme. No, it's a cat video. No, it's the Geek Fruit Podcast.
That's right, we interrupt this riveting broadcast to tell you about our show, the Geek Fruit Podcast, where Tejas, Dinkar and I, Jishnu, talk about everything in pop culture, including DC, Marvel, Star Wars, Netflix, and everything in between.
You know how your friends hate it when you ramble about some nerdy crap and you just want somebody to listen to you? Well, sorry, there's nothing we can do about that, but come listen to us ramble and it'll almost be like the real thing. Kind of.
Listen to new episodes of the Geek Fruit Podcast every Monday and the Geek Fruit Bulletin every Thursday on iTunes, Google Podcasts, the IVM app, or wherever you listen to podcasts. Happy listening, you nerds.
Give me a word. या कोई भी लाइन. कुछ भी हो सकता है यार. क्या कहा आपने? टोपी. Okay. Mohan Joshi hated wearing topis. He felt suffocated in them. टोपी पहनते ही उसे स्कूल की याद आती थी. Where of course he had no choice but to wear a टोपी. But जिस दिन पास आउट हुआ, उसी दिन उसने अपनी टोपी का bonfire बना दिया. And since then, he'd never worn a cap or a hat. ना कड़कती धूप में, and not even to बचो from the ठंडी. But from Monday 26th February, Mohan Joshi had to wear a topi all the time. Why? Because if he didn't, everyone around him knew exactly वो क्या सोच रहा था. They knew that he was wondering how the girl in the yellow churidar would look बिना कपड़े के. They knew when he was calling the boss a sadela टमाटर. They knew everything. पर ये सब हुआ कैसे? अरे भाई, यही तो स्टोरी है. और ये स्टोरी आप ही ने मुझे दिया by giving me the starting word. यही तो है The Croc's Tales. Words आपके, कहानी आपके लिए. Catch the stories on Monday and Thursday on the IVM website, app, and anywhere you get your podcast from. See you soon.